professor of finance over at Bogazici University. Taha, great to have you on the show. All right, for everybody who has a little bit of difficulty in understanding what is going on, one thing is clear: the financial world hasn't seen a 7 to 10 day period like this since 2008. Why is this all happening?
Well, the short of it is with increases, in order to stop inflation, the Federal Reserve and other central banks increased interest rates. When you increase interest rates, those who have receivables, bondholders, if you owned bonds before the Federal Reserve started increasing interest rates, your interest on those bonds is very little. But now suddenly we're at 4 or 5% is where the federal funds target rate is, which means bonds are paying that much, which means you can go to a bank and get 4 to 5% return on your money. And suddenly the 1%, 2% that you were getting before the Federal Reserve started increasing interest rates is not very attractive. So those assets, those bonds sold off majorly. They are very much underwater. They are, if you hold on to them, you have a loss. So to give you perspective, Credit Suisse is twice as big as Lehman Brothers was. The 2008 Great Recession happened really primarily because of the Lehman Brothers collapse and the ensuing contagion that happened. So the question is, will this Credit Suisse situation, which is twice as big as Lehman Brothers, do the same thing? That's where we are right now.
Let me ask you that. I mean, is this 2008 all over again?
Yes and no. Yes, it is in the panic aspect. It is. No, it's not. In that the 2008 crisis was based on worthless mortgage-backed securities, real estate prices that had gone through the roof. This is more based on these assets, these trillions of dollars worth of assets that are underwater, that have a huge loss attached to them. The FDIC, in my estimation, is the one that started this crisis itself, the Federal Depository Insurance Company, the company that insures U.S. banks, by announcing a number that everyone already knew, that said about $700 billion of losses were on U.S. U.S. banks' balance sheets. And that kind of spooked the market. And then 5 days later, Silicon Valley Bank happened, Signature Bank happened, and here we are with Credit Suisse.
Taha, what's your take in terms of what happens with central banks and their policy? I mean, because we've seen from former banking regulators, economists as well, and analysts on Wall Street, they're increasingly calling for the Fed to at least slow down or perhaps even pause the interest rate hikes.
Yeah, the Fed really is in a horrible position right now. I don't envy at all Jay Powell's position, because inflation is still continuing. The last inflation number we got last week showed that inflation, while slowing over the last few months, is still very much continuing. It's nowhere near the 2% target rate that the Federal Reserve has put. So the question is, will this week the Federal Reserve increase the interest rates by 50 basis points, which was expected? I highly doubt that. I would be surprised if they increased it by 25 basis points. And even if they did, I think we're going to hear a message that says, we're not going to increase interest rates again for at least 5 months, 6 months. We'll see. We'll come back to you in the fall and see what happens.
Okay.
Otherwise, this is going to get worse.
Okay, and we'll definitely have you back on as soon as possible. Taha Arvas, thank you very much for joining us here. I do appreciate it.